Canada's portfolios are largely focused on public market investments and Canadian real estate. Meanwhile, the US Sunbelt is adding jobs, people, and renter demand month after month. The problem is many Canadians want that growth, but they get stuck on cross-border complexity, tax concerns, currency risk, and who's running the building, right? So in this episode, we're going to discuss the simple investor first case for US multifamily in the South, why the Sun Belt fundamentals are durable, and how we structure cross border investments to avoid dual taxation, the real risk, and exactly how we manage them. Now, firstly, let's talk about why down south. So, we could be talking about sort of south of the Canadian border, but more specifically, we really are talking about the Sun Belt markets in the US. Bottom line is that's where the population is growth is occurring. So, some of those structural drivers of the Sun Belt, right? People and paychecks. Bottom line, that's where the immigration is going. States like Florida, Georgia, the Carolina, Texas are experiencing population booms. But not only that, many employers are relocating there, often for tax incentives, but also because it is more affordable. So, therefore, they could potentially save on paychecks, pay a little bit less. For example, if you work in San Francisco, and you own a business in San Francisco, you're paying a lot more for that level of talent than you would perhaps say in the Atlanta area. So not only are we seeing population growth, but we're seeing job growth. And sort of that diversified economy and business friendly climate is driving that in migration. I mentioned this just a moment ago, but that affordability, right? So it's just a little bit more affordable for people to live in these markets compared to, say, the coastal markets like up in the Northeast or the West Coast of the United States. So that better rent to income ratio, certainly as compared to, say, many Canadian metros, but even across the US, is driving strong household formation. Generally speaking, the southern Sunbelt markets also, in terms of policy, are more friendly, right? So, generally a little more landlord friendly. So, faster processes to remove non paying or disruptive residents, fewer rent controls, which allows us to better plan our business execution. Because at the end of the day, if it could take 18 months, like it can in some US markets and Canadian markets, to evict a bad resident or bad tenant, it's hard to build a business plan around that, right? In addition, the construction surge is fading in these markets. So it is submarket driven. So there are some pockets in the South that still have some large waves of supply coming. But many of the markets, particularly the markets Ferris Capital Partners focuses on, that supply wave has already crested and pipelines are normalizing, which supports occupancy and steady rent trade out, which is how we win in these deals, right? We have to have incremental increase in rents on the annual basis on renewals, on lease trade outs when somebody moves and a new resident moves in, most importantly on those renovated units where we're adding tremendous value by increasing the sort of desirability of the unit, which allows us to command premium rents. And we're also looking for metros in the Southeast that have good connectivity. So close proximity to major airports and logistic hubs that is driving employment, talent, and of course, reinforcing that demand. Now, you might ask why multifamily, right, versus other asset classes. At the end of the day, it all comes down to simple need. Shelter is a core human need, and that need will never go away. So, once again, people always need homes. So, that's why we're betting on multifamily. We also have the ability to cash flow on day one. So, by buying existing buildings that are already cash flowing, perhaps maybe there's some opportunity to fix some management inefficiencies or drive down some expenses or just provide a better resident experience. But the buildings we're targeting are already cash flowing and profitable. So you've got that steady cash flow coming in. We're not betting on, hey, if we reposition this property sort of like in an opportunistic way, then hopefully in a year or two will become profitable. These buildings are already profitable on day one. And our job is just to come in and to increase efficiency, improve operations, and renovate the building to drive those additional rents, which is forced appreciation. So we're not just simply hoping the market improves and valuations improve organically over time. Now, one of the benefits of real estate is that generally largely happens, right? Typically, values of rents are in line with inflation. And so apartment buildings rarely go down in value, except in, say, very rare circumstances like candidly what we just experienced where it was a little overheated in 18, 19, 20, and 21. People were paying premiums for buildings, and then the supply wave hit. Adjustable rate mortgages adjusted when interest rates tripled and left a lot of buildings in a challenging position. So this is not a foolproof way to invest. At the end of the day, operators like Ferris Capital Partners have to be very diligent in looking forward, not just 6 months, 9 months, 12 months, but years in advance. And so, for example, when we're touring a deal, if we see any vacant land within like a 2-3 mile radius, we're looking into it. What is that zone for? Is this a potential future multifamily building? For example, our Ferris residence Monk's Corner property had a huge piece of vacant land and a big for sale sign right next to it, right? So the first thing we did is we looked into that, realized it was not zoned residential. And as we dug deeper, we actually learned that the city had plans to convert that into a park, which came to fruition. So not only did we avoid a potential bad situation had we not done that due diligence and it was residential and now a new apartment buildings right next door to ours, but it's actually adding value in a sense because now there's an amenity that we're not paying for that our residents have access to. So that ability to cash flow on day one, enjoy appreciation that the market will naturally deliver, plus that forced appreciation we create with our value add strategy. And it goes back to that inflation alignment. As leases reset on an annual basis, we can actually adjust those rents to market level, where we're not capped on how much we can raise rents like in rent controlled markets. So why should Canadians be considering US syndications, right? So number one, it's truly passive. So we operate the deal and you own units in the partnership. Effectively, you're a partner in this business with us. We have on the ground property management, asset management, construction, and acquisitions teams. So we handle all the details. So your role as an investor is truly passive. We like to collaborate with our investors and we check in quarterly, send out updates on a monthly basis. So we're always ready to hear any feedback you might have. But at the end of the day, we operate the deal. So you just sit back and collect your cash flow distributions and at exit your upside. And the key factor here, though, is diversification. So, adding some diversification, getting into real estate in a way that doesn't require you to spend hundreds of hours of your own time, but also exposing your portfolio to the US just to diversify even beyond Canada. So it's an asset class diversification as well as a diversification into another country that perhaps has stronger demographics and stronger upside specifically related to real estate investing. So how do we make cross-border investing easy? So first and foremost, we have a Canadian LP structure that feeds into the US partnership. So this is designed for the Canadian to avoid dual taxation. So in other words, you only pay taxes on the Canadian side of the border. Just to be clear, if not done properly, if say, for example, you just decided I want to buy a rental property in the US on your own and you didn't structure it the right way, you could be taxed on the US and Canadian side of the border, which obviously would not be a good scenario. It would eat up most of your profits, right? Just in taxation. So we don't want that. On the other side, clear reporting. So monthly updates going out on a regular basis, timely tax reporting, quarterly check-in calls. We also offer different share classes. So you can decide, what share class is best for you. If cash on cash is more important, we have a share class that delivers strong cash on cash returns without the participation in the upside, but better positioning in the capital stack. And then we have different tiers. So the more you invest, the better your unit economics. So you can choose the right class that meets your investment criteria. And then just in terms of onboarding, we make it really simple. In Canada, you do have to work with an exempt market dealer, but we have a strong relationship with Equivesto. They'll get on the phone with you, navigate the entire process from start to finish to make it very easy. Now, at Ferris Capital Partners, we have 3 golden rules to protect your downside risk. So number one, fixed rate debt only. If we do any interest only debt, it's with a cap. I will say we have not ever done that. And I don't see us doing that anytime soon. It's not to say it wouldn't happen, but that fixed rate debt is super critical. So there's no guessing here. And we're not betting on rates going down in the future. If the deal doesn't work at today's rates, it's just simply not a deal that we're willing to do. Number 2, we keep 6 months principal and interest in reserve and a 10% contingency budget on our renovation. And we only buy cash flowing properties on day one. Rule number 3. So also some other things we do to mitigate risk is, we help with the currency exchange. So we have a couple of different options, but we found 2 options that will minimize that conversion and keep that cost of converting the capital to US dollars very low. We use conservative underwriting across all of our deals. work with third-party companies to verify taxes and insurance prior to submitting. So we have hard quotes going in. We're also doing that with our contractors. So before we even submit our LOI, we're very confident in our numbers. And we also stress test every deal and look for multiple exit opportunities. So perhaps a refinance. Generally speaking, we're looking to fully exit these deals in 3 to 5 years. But we also want to look at what would happen if selling the property wasn't the right move, but refinancing. What could that look like? And we're also looking at things like flood zones. So we only buy in areas that have very low to no risk of flooding. We're taking into account things like the age of the roofs and major mechanicals, and repairing and fixing any potential insurance exposure risks. So if roof needs replacing, we're doing that. We're fixing roofs. We're doing full jetting of our plumbing lines on day one and on an annual basis. So those major mechanicals, just making sure all those are running smoothly, and if not, making those repairs immediately. And in terms of execution, we attack the property on day one. So, at the end of the day, this is a decision you'll have to make. But from a diversification standpoint, understanding that in most markets in Canada, it is nearly impossible to find cash flowing real estate deals. Really, the only option for Canadian investors looking to sort of enjoy the potential returns of real estate investing are going to have to start looking to the US, because ultimately in Canada, it just becomes harder and harder every day. Now, if you've enjoyed this content and you'd like to learn more, go to fulloutinvesting.com. We have a sample deal on there, a video explaining how we do business and some of our unique approaches to execution on these deals. And you also have an opportunity to book in a time with us to connect to learn more. Thank you so much for listening. If you enjoyed this episode, please like and subscribe and share it with other high net worth investors that you think will benefit from it. We love and believe in you guys. Keep dreaming and investing big.